Hey there, my name is John Stevenson, the Guaranteed Retirement Guy. Welcome to the show. Today we're going to be talking about how to not run out of money during your retirement years. This is a big question. In fact, it's a big question for even before you're retired. You don't want to run out of money, right? So a lot of people have this question, and if you're looking around and you found this video on the internet, I hope that you'll look at some of my other videos, and they provide a lot of value as far as retirement planning, growing your assets, having guaranteed income, and of course, protecting it against market risk. So how do you exactly run out of money? Well, overspending usually is what happens. I mean, we overspend and we are not earning enough with that money, and we run out. So during the lost decade from 2001 to 2013, if you remember, the S&P 500 went up to 1,500 level, and then you had the great housing crash, and then it dropped, and then it went back up to 1,500, and it finally broke through the 1,500 around 2013 and started going up. The problem with that time is you had people that were retired or who wanted to retire and couldn't. Okay. And it was unfortunate because they were listening to their advisors, which were saying, hey, the 4% safe withdrawal rate, it's going to be great. You just take out 4%, you'll never run out, as long as everything does what it did 30 years ago. And of course, market changes. That is, to me, the most certain part of our future is that things will change. Okay. And so that's what happened. So people were taking out 4% safe withdrawal, and then the market dropped, and then all of a sudden they had to change that withdrawal rate to 10, 12, even 15%. And then of course you can kind of see how that works out. It's just unsustainable. So they started running out. And then as the market started recovering, they had way less money to recover with. And so that was a problem. And so maybe their safe withdrawal rate went down a little bit, but it never hit that 4%. Okay. That's the issue. You had the dot-com crash, and that was happening. And then you had the housing crash. So the problem is both of those kind of hit people that were retired and who were thinking about retiring, and they couldn't, or they had to go back out of retirement and they had to start working. And that's just because the safe withdrawal rate of 4% does not work. It's been debunked several times. It's more like 2%. And of course, most of us can't live on 2%. Unless we've got tens of millions of dollars. Okay. And most people don't. If you do, congratulations. There are still annuities out there that will help you gain a lot from your portfolio. Okay. So how do we not run out? Well, obviously living less than what you're earning, that is the key. But if you have a retirement need of $50,000, then maybe most of that is hopefully met with your Social Security, but most of the time it's not. Hopefully you have a pension, but if you don't have a pension, then you have to make up some of that difference. And so the only way to do that is to start withdrawing from your 401k, your IRA. And the problem is if you're 50, 60, 70 years old and you've been in the market for a while, you probably want to protect some of it because you know if the market drops, which it's not a question of if, it's just a question of when it happens. And it's also a question of when will we have a huge crash. They do happen. They will happen. And no matter what the arguments are for and against it, we will continue to have market crashes. We will continue to have corrections, large and small. That is certain. Okay. And so you got to prepare for that. And the best way to prepare for that, in my opinion, is through purchasing guarantees as part of your portfolio. Because here's the thing, you can have growth, and that's important, and you should have it. And there's nothing wrong with keeping your money in the stock market, even in your 70s. I don't think there's anything wrong with it, as long as you have guarantees. Okay, that's the thing. If you have some income set aside, maybe an annuity contract that's providing $30,000 a year, and you've got your Social Security and you got your pension, and you're good, then you can throw your other money in the market. You can throw it in, small cap, okay, large cap, no matter. You can throw it in whatever, because you know if you do have a bad 1, 2, 3 years, it's eventually going to go back up. And the nice thing is you don't have to sweat bullets. You don't have to stop traveling, okay? Because you got your income over here. It's being paid continually by your Social Security, by your pension if you have one, and your annuity contract. And maybe you might have a few of those contracts. And I have clients who have several. Okay, so I'm going to share my screen. I'm going to kind of walk this scenario through with you so you can kind of see how this would work for your retirement. Okay, so what I did is I just brought up someone who is married. Okay, they're married, and I'm going to pull up the income rider. I could do the SPIA. The SPIA is not bad. It usually provides a little bit less income. So usually you'll notice in my videos, I will defer to the income rider because it provides the most annual income. And that's usually what people want. Okay, so I'm going to go to the income rider, and the income rider is a rider attached to a fixed indexed annuity contract, okay? And it provides lifetime income, whether single or joint. It also allows you the flexibility to activate income whenever you want. Okay, a SPIA and a DIA, when you throw money in, you do decide at that point what date the income will start. You cannot change it after that. Okay, and those contracts do not have cash value like a fixed index annuity with an income rider. So keep that in mind. All right, so let's say my clients, they're married. They're both 60 years old. And I just made it the same age just to make it easier for just kind of comparisons. If your spouse is younger or older, it will affect the payout. Okay. So I have people that will buy this and their spouse is 15 years younger. They obviously get a lower payout because the insurance company is on the hook for the younger spouse's life as well. And they know if they have to pay out an extra $400,000 or $500,000 in income, they have to account for that. Okay. So you either have to put more premium in or you have to be happy with less during that time. Okay. All right. So I'm just going to show you an immediate payout based off $100,000. It's not going to be a lot, but this will kind of give us a baseline. Okay. If we look at that, and I'm going to say no income reduction right here, because if I don't click that box, you're going to see all these ones that start out large and then they go down. You'll notice that on my website. When you go to my website, johnstevenson.com, I got the calculators and they'll show everything. They'll even show the ones that pay higher amounts. But I want the ones that will never go down. Okay. So I'm going to click no income reduction. Okay. And then I'm going to do top annuity per carrier. Let that populate here. All right. So the top one is Athene. This is immediate. Okay. This is based off of you being 60 years old and your spouse is 60. So you're fairly young. They know that because you're both married and you're in your 60s, they know that the likelihood of one of you reaching your mid 90s is almost certain. Okay. So they know they're going to be paying for 35 years. Okay. So maybe less, maybe more if you live to 100, right? So that's what the payout is reflecting. If you were 62 and started income, it would be more. If you're 65 and started income immediately, it would be more. Okay. So, but you can see right now it's 6180 guaranteed. In fact, you'll notice that Gillico and Athene are both on the top spot. So in this case, I would just say go with Athene because they're older and they're A+ rated. Okay. That's a no brainer. You got Prudential right down below. You got Meritage, Nationwide, Corebridge, who owns AIG, Allianz, largest one in the world. It just depends on you, which one you would want to do. But I think any of these top options would be good, just depending on the amount of premium and what you're looking to do. Okay. But what if you don't want to retire? Okay. Right now, so you put the money in, you're like, all right, I'm 60, my spouse is 60, but we're not going to retire until 65 because we want our insurance to be paid for at least until Medicare starts. Okay. We'll say 65 years old. Now you purchase the contract now and you let it grow. Okay, there are certain contracts that are better for immediate, and there are certain contracts that are better for deferred. Okay, so in this case, Nationwide is the best for deferred. And you'll notice it's almost $10,000 per year guaranteed income. So that's pretty nice. You got Corebridge, you got Athene. Athene is close, right? But they're not quite the top spot for deferred. Okay, and then you got all the rest of the carriers. Okay, so what if you want to wait longer? Here's the nice thing about an income rider. You purchase it now, you're able to defer income for as long as you want. You might decide to take income now. You might decide in a year or 2, 3, 5 years, 10 years, it doesn't matter. The nice thing is you have it set up where it allows it to grow for your future income. Okay. All right. So this one, it brought it up a little bit, like another $1,200 a year guaranteed. And you can see Corebridge is the best one for that. And that's if you push it out 7 years. Okay. So it all depends on what you are looking for. Okay, and if you were thinking, hey, I'm loaded. I've got a bunch of money and I want to put $800,000 in here. Okay, throw that in here and you'll see that go up proportionally. So roughly $90,000 a year. Okay, pretty good income. If you got that plus your Social Security, maybe that's perfect. Maybe it's not. Maybe you need more. Maybe less is good. Just depends on you and kind of what your plans are now and in the future. I've got clients that move to the Philippines and they don't need very much income. So, but then they like to travel, so that costs. So anyways, things to think about when you're thinking about retirement. A lot of people think, oh, and I see these articles written and I write them too, where we talk about, hey, rule of thumb, you need at least 75 to 80% of your income. But my personal opinion is you should have 100% or more because there's always going to be something. Okay, what if you got grandkids, you want to pay for stuff? What if you want to go on trips? Okay, and you want to pay for not only yourself, but your grandkids and your family. Okay, what if you have a hip that you need replaced and it costs $50,000 and your insurance won't pay for it? Wouldn't it be nice to have just extra cash on hand to do that? That's why I like these because these are powerful in providing guarantees. Okay, so if your market your investments, your stock, bonds, or whatever, they're not doing what they're supposed to do, at least you got your guarantees over here taking care of you. Okay. So I'm not an advocate for putting all of your money into annuities. I don't think you ever should do that. In fact, insurance companies won't take it. But I am an advocate for at least setting yourself up for future success against longevity risk. And so again, we're talking about how not to run out of money during retirement. If you take $800,000, okay, and you take $90,000 out a year, let's say, but we'll be fair here. 7 years, you let it grow. So maybe that 800,000 grew to 1.2 million. So you were being conservative. You don't want to put it all in stocks. You kind of got a good mix and you got a good, decent return. So $1.2 million. Okay. $1.2 million. And then let's say you need to take out $90,000, as you can see, in 7 years. Okay. Well, $1.2 million. Okay. Divided by $90,000. That's 13.3 years. Then the income's gone. But let's say you're still earning a little bit, during that time. Let's say it lasts for 15, maybe 20 years. Let's just say 20 years. Okay. All right. So we look at that and say, all right, well, 20 years. And then the money's gone. Okay. It earns up to the point I take money out. It earns while I'm taking money out, but eventually it's gone. So if you compare that to an annuity contract, you take income and you notice that the account balance eventually does run out. Okay. Eventually that balances out. And again, we're doing this for income, not for legacy. There are products for legacy. But you can see by the time you're like 77, the money's gone. But it's a contract of income. You bought a pension. You didn't buy legacy. Okay. So you notice this comes out indefinitely, as long as you live. You take it out to 95, you take it out $2.6 million. That's really good. Okay. And you notice this lasts a lot longer than 13.3 years or even 20 years. Okay. It keeps going. Here's a 20-year mark. Your money runs out at 87 years old, right here. Well, what if you live another 10 years? You don't have any income. You see what I mean? And then, and again, that 90,000 was just, I was being very generous. I was being hypothetical. I was like, hey, it's going to get to 1.2 in 7 years. And it's going to continue to earn. And so that you can have a longer withdrawal time, instead of 13 years, it's 20 years. So I was being very generous on those. But even with all of those generous hypothetical numbers, you still run out by the time you're 87, 88 years old. Okay. Then what? That's why I like annuities, because it answers the question in a good way, how to not run out of money in your retirement, because it really, in my opinion, that's what you do. You purchase insurance to cover your retirement. You don't have to use all of your retirement funds. Just use the amount that you need. So obviously I am biased. Okay. I love annuities. I think they're important. I think they should be part of retirement plans. Everyone's different though. Some people don't need them. Some people do. Some people need them and they don't think they need them, or they need them for their spouse. And they don't realize that, yeah, their spouse needs it, but maybe they don't need it because they're, a day trader or whatever. They're making good money, but their spouse doesn't know how to handle the finances. And so they need to set up something for their spouse. Or if you have a child who is disabled, that's a good idea as well. Okay. They don't have the same skills as you. And so you set up contracts to take care of them. Okay. So anyways, things to think about. Obviously I am an advocate for annuities. I'd love to sell you an annuity, but I'm not going to try to sell you an annuity. I don't like to be sold, and I know you don't like to be sold as well. But if you are considering annuities for your retirement, book a call. There's a link below this video. It goes directly to my calendar, and we'll chat all things annuities. Okay, bring your questions. Okay, I'll be happy to help you, and I'll be happy to sell one to you if that's the way it goes. But if that's not something that works, and we find out that that's something that's not best for you, that's fine too. Okay, happy to help. And again, there is a link below this video, and there is a link on my website, johnstevenson.com, and that will take you directly to my calendar. It will book a Zoom call so we can see each other, and you can see my screen, and I can show you, and we can kind of work through the numbers together. Okay, so I really appreciate you watching. I really do. It's viewers like you that make it possible for me to continually educate on the importance of guarantees in their portfolios, and I appreciate you. So again, if you like it, make sure you click the like button and subscribe, and make sure you ask your questions below. Okay, there is a comment section, as you can see, and I'll answer those questions, and I'd be happy to help however I can. So thank you. I appreciate you. Thanks for watching. We'll see you next time.